And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. It is Tuesday. It is, according to my watch, the 19th of September, which means it's too damn early to start putting Halloween costumes and decorations out in your yard. So, and if you live in my neighborhood, stop it, quit it. October the 1st, that is as soon as you can put Halloween decorations out in the yard, okay? Not the 19th of September. Way too. I don't know what's going on. Driving out this morning, there's spider webs everywhere and lights. Everybody's just all excited about Halloween.
Well, shoot, Christmas is already up in the stores.
I know, it is. But, Halloween is the second most profitable shopping day of the year next to Christmas.
Wow.
So, yeah, go out and buy some stuff. Company needs it.
Chocolate.
You can buy stuff. Just don't put it in your yard yet. Just October the 1st. Jeez. Got to at least wait for the daytime to cool off a little bit.
Is your wife chomping at the bit?
Well, she's chomping all right. So last night I woke up, it was like 2 o'clock in the morning, and she's sitting up eating a bowl of cereal, watching TikToks on her phone. And I'm like, and I realized, I said, my wife suffers from a terrible disease called insomnia. So, it is just, so I couldn't go back to sleep after that. So anyway, I'm a little bit punchy this morning. So anyway, today starts the two-day Fed meeting, of course. Will they, won't they? That's the big question. Of course, on Wednesday, we'll actually get the announcement. Expectations, of course, are absolutely the fact that they're going to not hike rates, and keep them there, kind of the higher for longer type mentality. That's the broad expectation right now for the Federal Reserve. So again, probably nothing coming out of the Fed this week outside of the normal kind of what we've seen. Most likely just a kind of a regurgitation of kind of what we've heard the last couple of meetings, which is, keeping a watch on data coming in, and kind of just monitoring the inflation front. So again, don't really expect anything. Again, the Fed looks at yes, I know oil prices are up here over the last couple of weeks, but again, they don't look at that because they look at the core. So they strip out energy and food prices to look at core readings, which have been kind of in line with expectations. So again, not a lot of surprise out. Yesterday, the market kind of rallied early on in the morning, started off a little bit weak, rallied into midday, then sold off at the end of the day. And again, we've kind of been talking about this, is that markets are not really kind of wanting to do anything ahead of the Fed just in case there is some surprise event. And that's kind of really the story here. This morning, futures are pointing up again. This morning, Dow's looking to open up about 30 points. So again, just kind of going to be another kind of sleepy day in the markets as we kind of wait ahead of this kind of FOMC meeting. We're done with earnings for the most part. We have a few little earnings dribbling in here and there, but by and large, all of the earnings for second quarter now have been reported, and so we don't really have a lot to drive the markets. Not a lot of important economic data, etc. So again, kind of a sleepy day here probably for most of the trading day. Probably won't see a whole lot until tomorrow afternoon when you actually have the FOMC announcement and then potentially fireworks. So we'll see what happens. Speaking of oil though, one thing this has kind of been on everybody's radar as of late because oil prices have been creeping up, but oil prices are back to very, very overbought levels. And, not just on an RSI basis, which on a relative strength basis, oil is probably the most overbought that it's been since, at any of its previous peaks. So again, very nice rally in oil over the last couple of weeks, but again, very extended here, very deviated above long-term moving averages as well. So expect a fairly large correction here in oil prices, probably back down towards the mid 80s to low 80s would not be surprising at all. And that could potentially happen anytime. What causes that? Oil prices have also been rallying X other commodities. So again, this has been a very specific kind of commodity rally, and generally more sustainable rallies in oil will correspond with rallies in other commodities as well. That's not really been the case. So again, pretty much a good technical rally at this point, driven by most of the NYMEX traders, but again, very, very extended, very overbought here. So look for a pullback, which also pulls some of the worry off the inflation front as well when it happens. But again, just we are very rarely this overbought going back in history. And again, if we just take a look at a little bit longer time frame, when you have these kind of more kind of egregious overbought conditions like you have now, it's typically corresponded with a correction of some sort. So again, just markets can only move so far in one direction before ultimately you are going to get a reversion of that price movement. So again, with us now back to previous resistance levels that we were back at September of last year, don't be surprised if we get a bit of a correction back again. And again, somewhere mid 80, high 70s would not be surprising at all. Just kind of a normal correction within the overall market. So again, just kind of watch that. That's been one kind of the big drivers that have been getting a lot of attention as of late here. So don't forget to take profits in your energy stocks. They've had very nice runs. So pull back a little bit there. Also, small and mid caps continue to really kind of be the laggards of the markets. And if you take a look at the differential between the S&P 500 and what's happening in small and mid cap stocks, that's also been concerning. Here's what you need to know before the bell. The market over the next couple of days is starting to kind of price in a little bit of what they expect to happen. So if we take a look at the S&P 500, we've been kind of just really holding flat here for the last couple of days in particular, but really kind of supporting along this consolidation line that the market's kind of been holding on to. Had that correction back in August, had this rally here just recently, kind of stalled here, consolidating a bit. We're very, very kind of getting back to oversold conditions, close to triggering a short-term sell signal. But again, that can reverse if the market does rally. So again, as we look forward to the FOMC meeting tomorrow, if the meeting comes off in a more dovish manner, we could expect to see this market rally here a bit. So again, as we kind of move through September and into October, and part of what we'll talk about on today's show is, again, we're getting set up for that kind of seasonally strong period of the year. We're not there yet, but again, as you kind of tend to look at the markets and where we're setting up, confidence has settled down a bit. Sentiment has come back a bit here. Allocations have also been reduced here a bit, and that's kind of that setup that you need for a bit of that kind of year-end performance drive as we start looking into the end of the year, portfolio managers needing to rebalance portfolios, etc. So again, nothing really concerning here. We continue to try to consolidate this very tight, this channel that continues to tighten a bit here. We're getting a very compressed level of prices. So we're going to get a move one way or the other. It could break out to the downside. A break to the downside, we're going to be retesting the 100-day moving average. Break out to the upside, we retest previous highs. So again, there's certainly room for this market to break to the downside. If we take a look at volatility, it has been very suppressed here for quite a while. And in fact, we haven't had a day where the S&P has been down more than 1.5% in more than 100 days. And that's a very long period. But again, volatility remains very suppressed here. So there is certainly a risk of a downside break. So don't, completely dismiss that. But even if that occurs here in the short term, I expect it to be short-lived as we start to get set up for that kind of year-end rally. We'll talk about that some more this morning, but that's what you need to know before the bell. Coming back from the break, we will get into what kind of this year-end rally might be and what are going to be the drivers. We'll talk about that next when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Two things in life you cannot avoid: death and taxes. Be better prepared for both with our next Candid Coffee on progression planning for a life well lived. Saturday, September 30th, with Danny Ratliff and Richard Rosso. We'll share how to prepare emotionally, financially, and pragmatically. Register now at realinvestmentadvice.com. The Progression Planning Candid Coffee with Ratliff and Rosso. Saturday, September 30th. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So welcome back to the show this morning. So again, this today's article on the website talking a little bit about some more weakness potentially. And as I said, just for the break, we've gone more than 100 days now without a market decline of more than 1.5%. We got close to it earlier in the week. We got about 1.2%. But again, we haven't had a day where the market was down more than 1.5%. Closed that way too. So, that doesn't necessarily mean it has to happen, but again, it's a fairly long stretch of time where you haven't had a pickup in volatility. Again, volatility remains very suppressed, and this potential for a downside break certainly is out there. But with that, and that could certainly happen, again, a little bit of a shocker announcement from the Fed tomorrow, some other type of event pops up, could certainly cause that short-term pickup in volatility, but markets are getting back to pretty oversold. So even if it occurs, it will likely be fairly short-lived. And that will, again, kind of contribute to the setup kind of for this expected year-end rally. Now, does a year-end rally have to occur? Absolutely not. Statistically speaking, it tends to happen more often than not, and that's why we want to give it some weight, because there are more times than not that the market rallies October, November, December than it doesn't. Now, we can certainly bet on the one-offs that it may not, and it might not. This might be one of those years. They're rare, but this might be one of those years where the market doesn't do great into year-end for a variety of reasons. High interest rates, tight monetary policy, the Fed, is more aggressive than expected. I mean, there's some things that could certainly happen. And so we certainly don't want to dismiss that probability. But if we take a look at kind of the years in the past, going back 20 years, and we just kind of average the performance, Equity Clock does a really good job of this. You can kind of see the average year in the market. And, if you take a look at where we are right now, this kind of September-ish, October-ish period, you can see the markets are kind of flat. They're volatile. They potentially kind of move around here a bit. And then you have this October, November, December run. So why is it that you have this year-end kind of run? And there's some reasons for that. But if we go back in history, and I did some analysis back to 1957, and if you had only invested in two periods of the year, so you either bought October through May or you sold May or you bought May through September. And the difference is quite substantial, right? So if you had bought only the seasonally strong period of the year, your performance was dramatically larger than what you had by investing in the seasonally weak period of the year. Now, does that mean that summers are always negative? No, of course not. Summers are sometimes positive. But if there's going to be weakness in the markets, it really tends to show up in the summer months, particularly August, September, October is for some reason why all the major crashes occur. So, those certainly have impacts to markets. But so again, there's a lot of statistical support for this seasonally strong period of the year and why we don't want to completely dismiss it entirely. Now this year so far has been, if we take a look at that equity clock again and look at how the market rallies at the beginning of the year, then kind of goes flatline in the summer, and then you have this strong year and rally. It's exactly kind of what the S&P looks like this year. You had kind of a very strong beginning of the year, and really since about July, the market's gone nowhere. So it's just really July, August, and so far in September and potentially in October, not making a lot of gains here, but not really going down anywhere, just kind of consolidating all that advance that we had from earlier this year. And of course, that's really been driven by those top 10 stocks, we've talked about before, and the deviation in performance between the S&P, kind of market capitalization weighted index and the equal weighted index is quite large. Again, this has been really kind of a one-sided market this year for the most part. But again, that's just kind of the way this market has worked out. Last year was that way too. Energy was the leaders. But as we kind of start thinking about the drivers as we head into the end of the year, there's quite a few things that could help support it. First of all, we're about to go back into earnings season, and yep, it's that time again already. We just finished it, and we're about to kick it off again in October. And if we take a look at earnings estimates going back to last year when analysts first started announcing the quarter 3 estimates, right? So in last February, they laid out their estimates for quarter 3 of this year, and their initial estimate came in at $229 a share, and that had actually risen up to $236 in May of last year. Now it's down to $187. So again, this is why companies are always able to beat the estimates, because we continually just ratchet these estimates down, and then companies come in and they go, hey, here's our numbers. Like, oh, you beat the number. Well, if you had kept the original, if we held analysts to their original estimates, we'd have 100% miss, right? Nobody would beat their earnings. But this is the game that we play. So these very suppressed earnings estimates are certainly a support for the markets, because now we have a lot of companies. Well, we'll get that 70% of companies have beat earnings this year. Well, it's because we lowered the bar and they beat earnings. But that helps give support to the markets, particularly as we go into the end of the year. Also, professional managers here recently this summer have gotten a bit more bearish. Back in July, they were very bullish. They were over 100% allocated to stocks. We were at 101% allocation to stocks using some leverage. Now we're down to 57%. So professional managers have reduced their equity risk exposure this year. So now as we move into the end of the year, if the market starts kind of moving higher, they're going to have to put that exposure back on. That's going to provide some buying power, some lift to the markets, particularly as they head into the end of the year. The drag in performance this year, as we showed earlier, that difference between market cap and equal weight, if you have a normal portfolio that's kind of diversified among, different stocks, you have the bottom performance. If you own 7 stocks, you have the top performance, and that's and for most managers, they own stocks that look more like the broad market. So, their performance is lagging this year because they don't have that weight in those mega cap stocks. So there'll be some potential performance chase to get those stocks into their portfolio this year, as well as to get their performance up. So again, being underweight stocks going into the end of the year, if the market starts rallying, they're going to have to get that exposure on, and that's going to help provide some lift to markets. And then, of course, we can't forget that starting as soon as we get through October, the bulk of earnings will be in for the S&P 500 companies, and the windows for for stock buybacks open back up. Companies can't buy stock during the earnings announcements. Once that's over, their window opens back up, and we're going to have roughly $5 billion a day in stock buybacks coming into the end of the year. So again, another support. So you've got underweight performance. First of all, you've got underperformance by managers. Have to play catch up. They're underweight equities going into the seasonally strong period, and you have these $5 billion a day in stock buyback. So there's certainly plenty of catalyst. There's kind of some pent up buying as we head into the end of the year. And just statistically looking back in history, another support is when you have a big beginning of the year where the markets are up more than 10%, the end of the year, the fourth quarter tends to be up by about 4% or so as well. So again, just kind of across the breadth of statistics and analysis, etc., there's certainly a case to be made why the end of the year could be a bit stronger for equities despite short-term weakness. So again, yes, I realize we're having some short-term weakness. There's certainly some concerns about things. That's actually a positive for the markets. Again, remember, markets are a contrarian instrument. So when everybody's kind of negative about something short term, that usually is a setup for something else to occur. When everybody expects one thing to happen, something else tends to occur. And so again, a lot of this negativity that we see at the moment, this kind of bearish attitude that we're seeing, is a good setup to help fuel that rally into the end of the year as those bears have to be pulled back into the bullish camp. And that's just kind of normally how this works. So again, the whole point of this is not saying that we're absolutely positively, going to get through the end of the year and it's going to be wonderful and nothing but, roses. And as I talked about at the opening segment today, the volatility index remains extremely suppressed. And that is certainly a concern. In the short term, at least, this market could have a decent little sell-off here. And there's no guarantee. As I said, this could be one of those more rare years where October, November, and December doesn't perform well. Back in 2018, didn't perform well in November and December. Had a 20% decline back then because the Fed was at that point kind of freaking out over trying to hike rates, and we were nowhere close to the neutral rate, and the markets were down 20%. And in 2019, we're cutting rates back to zero again. So, it could certainly happen, right? The Fed could come out, say something tomorrow that could certainly shock the markets, pop that volatility index, get a sell-off in the markets. It could certainly happen. It's more of a rare event than not. So again, we kind of have to place our bets. I'm not saying just go, balls to the wall in terms of just, putting everything out there in equities on a guarantee that the market's going to rally into the year end, because it's not. There's no guarantee there. But again, we're just looking at statistics and odds and probabilities. So, continue to manage risk in your portfolio, but be careful being overly bearish here, because this market may very well surprise you heading into the end of the year. All right. Wraps that up. That article on the website this morning, by the way, just simply go to realinvestmentadvice.com. Be right back after the break, and we'll see if the Fed's getting in the economy they expected. Talk about that next, right here on The Real Investment Show.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Two things in life you cannot avoid: death and taxes. Be better prepared for both with our next Candid Coffee on progression planning for a life well lived. Saturday, September 30th, with Danny Ratliff and Richard Rosso. We'll share how to prepare emotionally, financially, and pragmatically. Register now at realinvestmentadvice.com. The Progression Planning Candid Coffee with Ratliff and Rosso. Saturday, September 30th. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I was fired up yesterday over something one of my kids did. My daughter got a ticket in Sealy for driving too fast. So I'm all fired up over this.
The Real Investment Show podcast.
It is very common in my household because my wife has ADD, so she's constantly having to do something, right? So it's very normal for us to have a full-blown, even an argument, right? And she'll be like washing dishes and doing other stuff. So it's I'm completely used to her not looking at me when we're having a conversation.
She's multitasking.
She's always multitasking.
The Real Investment Show podcast. Same show, your schedule.
So I come in, I'm all fired up over this because she apparently let my daughter get away with this. But, look, I don't yell. I don't raise my voice. I state my case very calmly. I use facts. I used figures, and she didn't respond. She just kept doing it. I was like, I won this argument. And then she reached up underneath her hair and she pulled out her earbud and she says, "Yes, dear, did you say something to me?" And I was like, "Yeah, I asked you what was for dinner."
At realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. Of course, all eyes are on the Fed meeting tomorrow, and of course, Michael Leibowitz and I will dig into this much deeper on Thursday once we actually have all the, have the announcement, and then of course the presser that Jerome Powell will give. We'll kind of dig into all of the nuances of whatever was said, and of course how the market responded. But Federal Reserve policymakers for inflation. They're thinking that inflation is potentially where it is, and they're still concerned about inflation. And I thought this was kind of an interesting article from the Wall Street Journal this morning. Federal Reserve policymakers' projections for inflation this year look as if they could be too high, while their GDP projections look too low. And I thought that was interesting because, of course, the Fed's long-term outlook for GDP growth is around 1.8%. And, last quarter, GDP has been coming in a little bit stronger than expected because of the Inflation Reduction Act, the spending that came from that, the wrapping up of a lot of the benefits, extended benefits payments that were being put out. Those ended in December. Of course, there's been a moratorium on student loan payments, which are just now starting. So that's helped kind of fuel some of the spending earlier this year. So, as the Federal Reserve kind of sits down, when we take a look back at the history of their projections, it's actually been quite the opposite. Their projections for economic growth have always been too high. And, because every quarter the Fed comes out with their projections of employment, inflation, and economic growth. And their economic growth estimates are always wrong. They start out too high, and through the end of the year, they have to continue ratcheting them down until you kind of get to where economic growth is, kind of like earnings estimates for companies with Wall Street analysts. They're always wrong too. But the question right now is that, the economy's been a bit stronger than everyone kind of expected coming into this year. Now, remember last year, everybody was expecting a recession. And now that now that economic growth has been a little bit stronger lately, everybody's like, oh, well, there's no recession now. We've bypassed it. And this is that proverbial soft landing that everybody's been hoping for. And as we talked about yesterday, that's been, very much a hard thing to stick for the Federal Reserve. Timing is always the issue. But again, the last time that the Fed released projections at their June meeting, they showed that policymakers on balance thought that their preferred measure of consumer prices, inflation, was about 3.2%. And that was a little bit higher than where we were during that quarter. They forecast that core prices, which exclude food and energy and better capture inflation, would be at 3.9%. So those were both a little bit too high. The good news, kind of in a way, is for the Fed is that since inflation has come in really lower than their projections, that gives them room not to hike rates at this meeting. And that, again, that's pretty much what the market is expecting. And, the one thing that the Fed is kind of abhorrent to do is to shock the markets unless they need a shock. Now, in the past, they've done this. They've gone into a meeting. Everybody was expecting a 25 basis point hike. They come out, boom, they hit it with 50 because they need to have a shock to the markets to get, excess sentiment out of the markets. Or we've seen intra-meeting rate hikes where they were concerned about inflation getting out of hand, and they would hike in between meetings and completely shock the market. So it's not outside the realm's possibility for the Fed to shock the markets at tomorrow's meeting. It's just they most likely won't, and they generally don't. They generally kind of listen to the markets, and this is why they trot out these speakers on a regular basis saying, they have Bullard and all these other guys going, well, I think that, we need to hike rates a whole lot more, and then they monitor how the markets react. Well, and then some guy comes out right behind them and says, oh, we don't need to hike rates at all, and they see how the market reacts. And so they get a gauge of what they can kind of get away with in terms of their policy. And they go, well, so the market seems to be kind of set up here for a 25 basis point hike, so that's where we're going to go. And then they do that, and it's no big deal for the markets, and everything's fine. So, the Fed's projection for gross domestic product in June that it would grow just 1% in inflation-adjusted terms in the fourth quarter from a year earlier. Economists polled by S&P Global Market Intelligence last week estimate that GDP will be up 1.8% in the fourth quarter. So about, almost twice as strong as what the Fed was thinking. Now, the problem with these projections and the economic data is the lag effect. And I'm not talking about the lag effect of interest rates and what's eventually going to happen. It's the lag effect of getting the actual data in. So remember, at the end of a quarter, there's 3 estimates of GDP for each quarter. So if we go back to the end of the third quarter, right, and we start and we go, okay, well, the quarter ends, and then we almost immediately get the first estimate of GDP. Now, where does that estimate come from? Because there's no data, right? The quarter just ended. The data hasn't really come in yet for the last month in particular of that quarter. So where does the estimate for GDP come from? Well, that estimate comes from the Fed taking a look at a poll of economists. And so they take a look at all the kind of the what they call the blue chip analyst estimates, and they derive the first estimate from that pool of blue chip analyst estimates. So the Bureau of Economic Analysis takes a look at that pool of estimates and say, okay, that's the first quarter estimate. In the second month of the following the end of that quarter, they then have some of the data that's coming in. So now they've got data coming in that they can begin to tailor or trim that blue chip analyst estimate into an actual formal estimate. Then we do that again in the third month of that quarter. So by the end of the third month, we now supposedly have enough data in to actually calculate what the estimate for the previous quarter was. But even that is early, because we don't really have a good look at all that economic data and what's really going on, because again, a lot of these are surveys. How do you feel about things? Some of it is hard data, but a lot of it's kind of still early in the makings. And so a year later, we then revise that estimate again. Now, we don't pay much attention to those revisions, but a year from now, we'll revise the quarter estimate again, and we'll find out that, it wasn't 1.8%, it was 1.3%, whatever it was. Then 3 years later, we revise it all again. So, and again, we don't pay much attention to these revisions, but this is why the Bureau of Economic Analysis, and more importantly, the National Bureau of Economic Research, which is the organization that dates recessions, why they're so late. They're always 6 to 12 months after the fact of going, the recession started in Q3 of last year. But in Q3 of last year, we had 1.7, 1.8% economic growth. Well, no, we didn't. It was actually negative growth. We just didn't know it until now. And so this is always the problem. These analysts, first of all, they are biased by the fact that, producing positive economic reports, A, gets them exposure. B, that's what their members want to hear. And so they sell product. They sell this research. And so there's generally a bias to be positive, to be optimistic, because optimism sells. So there's generally an always optimistic bias to the outlook for the economy. Now, there's some data right now that certainly suggests the economy is doing okay. And we can't, unemployment's still low and those type of things. But if we take a look at a broad swath of other indicators, yield curves, leading economic indicators, manufacturing reports, et cetera, all suggest the economy is much weaker than what the GDP projection currently says. So again, while it may seem like to at least to the Fed, right, that the economy is firing on all cylinders, unfortunately, we won't know until after the fact. And then, of course, the absolute fact that we have these, interest rates that have gone up, the Federal Reserve's been hiking rates, the 10-year Treasury is up, that lag effect from those higher rates, and now add in the student loan repayments and the other things are certainly going to weigh on economic growth, not to mention the potential for, government shutdowns we talked about yesterday, the auto worker strike, all potentially adding drags to the economy. So it may seem like right now that fourth quarter economic growth is going to be 1.8%. By the time we get there, it could be substantially less. And again, even the Fed is almost always too optimistic about their projections for economic growth. So again, I don't know personally where we're going to be. I mean, we can all take some kind of pencil in about what we think, economic growth is going to be. But, the problem that has always kind of resided is that optimism about soft landings has been a very rare event in the overall market. Just something to think about. All right, take a break, come back, wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Two things in life you cannot avoid: death and taxes. Be better prepared for both with our next Candid Coffee on progression planning for a life well lived. Saturday, September 30th, with Danny Ratliff and Richard Rosso. We'll share how to prepare emotionally, financially, and pragmatically. Register now at realinvestmentadvice.com. The Progression Planning Candid Coffee with Ratliff and Rosso. Saturday, September 30th, realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show. So, kind of an interesting evolution that's been going on in the markets for a few years now. And again, it's been hailed as a positive for investors, and there's certainly a case to be made for that. But you also have to ask yourself the question, is it good long term for the markets? And that's been ETFs. Exchange traded funds. And there's a push right now towards zero cost ETFs. And this has been kind of an evolving thing as ETFs are being issued. And again, so think about it this way. Brent has a ETF company and he issues index-based ETFs. So he has an S&P 500 indexed ETF and his ETF tracks the S&P 500. Okay, and he charges half a basis point for that, right? So you're going to pay a small fee to buy that ETF. That small fee, of course, is what pays for the operations of his company and the hiring of the employees, the traders, everything else that goes on, right? So he's got to make some money doing this. So if I want to issue an S&P 500 ETF, and I have my company, right? So I'm going to issue an S&P 500 indexed ETF. What's my differentiator? How is my indexed ETF going to outperform Brent's indexed ETF? Because they're exactly the same. So the only thing I have to compete on is cost. So if I want you to move your money from Brent's ETF to my ETF, I've got to charge you less. So I charge you 0.4 basis points a year. And then the next guy that launches an ETF says, well, I've got to charge less. And so there's this drive lower in cost. So the question, and now State Street, which is one of the companies out there issuing ETFs, slashed the fee on its cheapest S&P 500 exchange-traded fund to just 0.02%. So in other words, on a $1,000 investment in their indexed ETF, you'll pay just 20 cents a year in fees. So you should buy that ETF. If you're buying an S&P 500 ETF, you should look for the lowest cost because that will boost your performance. So you have to ask yourself the question, though, okay, how do I make money? Right? So I've got to have a space. I got to have traders. I've got to have computers. I got to pay payroll. I got payroll taxes. I can't issue an ETF for free. I got filing fees, legal fees. I've got SEC registration fees. I've got all these costs. So how do I make money? At 0.2%, 0.02% a year, I got to have a whole lot of assets to generate enough income to pay the bills. And I thought this was interesting because there's an article about this on the Wall Street Journal this morning. And let me just read to you from it. An individual investor can now build a fully balanced portfolio using ETFs without paying more than 0.05% in total fees. This is according to Susan Thompson. I think we're getting pretty close to the end. Yeah, 0.02 is pretty close to the end. If someone goes to zero, then they're doing it as a loss leader. Okay. So why would I issue an ETF at 0.02 or even, and once you're at 0.02, you might as well go to zero. And why would I issue an ETF as a loss leader? How does that get me money? Right? This is the question you need to ask yourself. See, free is not always free. So if I'm going to issue something at zero, what's the benefit? Well, see, you have to read this article very carefully because they accidentally reveal how the company is going to make money. And if I'm offering these things at lower and lower cost, and it's not just State Street, it's Invesco, it's other companies as well that charge very low rates. Both State Street and Invesco are just kind of two of the leaders of this cut of these ETFs. And then buried in the article here, and again, if you're not reading it carefully, you're going to miss it. There's this one sentence. Both State Street and Invesco are able to offer lower cost versions of their most popular funds because there are professional traders that need the liquidity provided by the bigger funds to transact in large sizes. Now, what does that mean? This is called payment for order flow. So I've got payment for order flow. We talked about that before with Robinhood. I've also got dark pools of assets, which are out there. So if I'm a big pension fund and I need to move, 1 million shares of Apple, whatever, I've got to have somebody to sell it to that can buy very large quantities, and there's a cost for that. So it's what happens behind the scenes of that ETF is how these companies make money. So again, how do I provide a fund as a loss leader is by doing this by selling order flow somewhere else, which is a cost to you, right? It may not show up, you may not see it, but it costs you over time. And, we've gone through, we've talked about this before, but again, you should, there is no such thing as a free lunch ultimately at the end of the day. And, this is why it's that sometimes paying for something is not always such a bad thing. We didn't have payment for order flow and all this stuff back in the 90s when markets just operated. Yeah, we paid commissions, and if you bought or sold something, you paid a commission to buy or sell a stock. And it was open, it was transparent, everybody knew what was going on. And now that we've been pushing more and more into this world of ETFs, it's creating other problems. And again, we've talked about the bifurcation of the market this year. The reason that the S&P is outperforming the equal weight so much is because of all the money flow that goes into Apple, Microsoft, Google, Tesla, NVIDIA, because they're in the top 10 holdings of the S&P on a market cap weighted basis. Those absorb about 30 cents of those 10 stocks, absorb about 30 cents of every dollar that's invested into the S&P 500. So when you go out and buy this fee-free S&P 500, that's fine. 30 cents of that dollar goes into those top 10 stocks. valuations matter at some point. But this ETF drive that we've been doing has been distorting markets now for the last several years. It wasn't such a, at the beginning of this, and this is always the problem of these new inventions of when we do things, right? In the beginning, it really, this is cool, right? What could be wrong with this? And then once it becomes Jaws and it absorbs everything in the ocean, all of a sudden, people are going to realize it's a problem. Now, it's not a problem yet, right? And I don't know when it'll be a problem. But at some point, there is only so much money that can go into Apple and Google and Microsoft, et cetera. There's only so much money because valuations will ultimately matter. At some point, somebody somewhere is going to say, I can't justify paying that much money for shares of Apple. They just don't grow fast enough to justify that. And the problem ultimately comes is that when selling starts, just as if all these passive inflows coming in drive markets higher when markets are going higher, but at some point something breaks. Don't know where. It could be 10 years from now, right? But at some point, the realization of the distortion of the markets created by ETFs is going to be a problem. And just like it fueled the rise in the markets, when people start liquidating ETFs to get out of the market, 30 cents of every dollar that comes out of an ETF comes out of Apple, Microsoft, Google, Tesla, right? And then as those stocks come down, that forces more selling, which forces those stocks to come down even more, which forces more selling, which you see the problem. And that's how eventually you wind up with a 50% correction in the markets that nobody can think can ever happen. It's those 1 in 100 year events. But again, you have this animal of ETF sitting out there, and it's just this giant Hoover vacuum just sucking up assets. And again, there's nothing wrong with that right now, right? I mean, if I just want to track the index, and there's nothing wrong with that. S&P is going up. I got to put money into my S&P 500 fund. There's nothing wrong with that. But as those costs become cheaper and cheaper and cheaper and cheaper, they absorb more and more and more of the assets. And again, this is the question that really nobody's asking. Financial advisors have given up trying to actually manage money. They just slap you into a bunch of indexed ETFs and go, well, you're diversified. Hold on. Next 30 years, you're going to be great. But at some point, you have to ask yourself, when does this distortion become a problem? And what's the outcome of it? I don't have the answer. It just seems to be an obvious problem that's going to be out there somewhere. And unfortunately, we just typically don't recognize it until too late. And we've seen this before, right? This isn't the first time we've come to this, event. We've had these periods in the past where there was this one kind of focused thing that everybody was in, and it always ended badly. Maybe this time will be different. I don't know. I just have a sneaking suspicion it won't be. But that wraps up the show for the day. Be back tomorrow with Danny Ratliff. We're going to be talking about retirement planning and a whole bunch of other stuff. So again, tune in tomorrow. We'll pick up with that. Get by the website today. Our latest article is out on the website, realinvestmentadvice.com. Have a great day. See you back here tomorrow.